Wednesday, May 8th, 2024, Monaco 64, home of alternative economics and contrarian views. We're starting to see a few articles in the mainstream about gold being overvalued, that the savvy Britons, for example, are taking profit with their gold, right? Taking advantage of the rising gold prices. So what I'm going to look at today is the technical picture, the fundamental picture. And of course, some people are just technicians, some are into fundamentals. And as many of you know, I worked in the city of London for over 20 years. And actually, I focused on both. I always told myself, why just focus on technicals or just on fundamentals? Why not both and give your client the best possible service? Of course, there are brokers and salespeople out there who only focused on really doing the business. That was not my forte, the very close relationship with their clients. Not to say that I didn't have, but that's how it worked. And I always thought, why just stop at looking at technicals? Why not look at both? So what we're going to do today is look at some examples of what the mainstream is saying about gold. We're going to look at some of the fundamentals and the technicals, which I think are very important. And before I do, though, I just wanted to let you know that my affiliates in the precious metal space have, as usual, their specials. Miles Franklin this week, they've got 2024 1/10 of an ounce gold Canadian maple leaf coins, only $29 over melt. They've got 1 ounce South African silver Krugerrands, only $3.10 over spot. Here in the UK, Gold Investments, they still have their specials. You can check that below in the description of this video, and you can give Oliver or Simon Temple a call. I've been dealing with Gold Investments since 2002, when their dad was running the business. For Miles Franklin, you can call him on 1-800-822-8080 and mention Mario or Monaco 64, or you can mention me again through an email, info@milesfranklin.com. Maybe some of you who are new to the channel and new to gold and silver, after my video today, you might want to consider it, but I'm not pushing anyone to buy gold and silver. The reason I talk about my affiliates is that years ago, people asked me for it. So this is not the purpose of my video to sell gold and silver. It's to inform you about what I think is the best way to protect your monetary savings from currency debasement. And that's what we've been having since the beginning of the century. And why is that? And this is now the fundamentals for gold and silver. Well, in 2002, I bought my first gold coins. And why did I do that? Well, because we just had the dot-com bubble burst. My pension, private pension that I had, got hit hard. And my wife and I sat down and talked, and we said, well, why not maybe buy a little bit of gold? So gold at the time was around $300. I think the day I bought it, it was 222 pounds or $320 at the time. So it's been a long-term thing. And why the currency debasement? How did I see that? Well, following central bankers and monetary policy. And one thing that really triggered, not fear, but an alarm in my head that I needed to keep saving in gold was Ben Bernanke's helicopter speech in November of 2002, where he told the world, even though he wasn't chairman at the time, but he was up and coming, that the Fed was going to, in the future, was going to print as many dollars as needed to keep deflation at bay. Of course, it's a joke. We haven't had deflation. If anything, the money supply has ballooned. Deflation is not prices dropping. It's the money supply dropping. And that's what most people don't realize. And that's why the fundamentals are still great for gold, in my opinion. So let's skip to technical analysis now. And many of you know about the teacup and handle formation. It's a technical formation. So now the technical analysis. Some people think technical analysis doesn't work, but I think it does. And I first heard of the teacup and handle formation from Jim Sinclair, who unfortunately passed away last year. And it was just around the time that I had started accumulating or stacking gold and silver. And this was back in around 2004-05. And as you can see here from this chart, there's a big teacup and handle formation back in the day. And it started back in the mid-90s. The cup started forming. And I never heard of it. I'd done technical analysis courses in the 90s, and no one's ever talked about it, but Jim Sinclair did. And basically what he said is that it's like a consolidation formation where prices, stay under, kind of suppressed, and then eventually they go up and massively. And there's a little handle at the end of the chart where it consolidates. And in 2004 and 5, that handle was there for about a year or so. And then it took off, as you can see, at the end of 2005 from just above 400, around 430. I remember that level well. And, it went all the way to just over 1,000 by 2008. And then by 2011, we'd gone to 1900. That's how powerful these teacup and handle formations are. And they can be long and frustrating. Yes, they can. And they can turn and become a top. But as you can see, since 2011, it hasn't turned down the current teacup from 2011 to 2021. The handle took a long time to finally, the price break out of the handle. It took 3.5 years, so a lot longer than in 2004-05. So it wasn't a top, and it's taking off now. And I think the consolidation in the handle has been really long. So we have, in my opinion, and this is never certain, right? These are probabilities, but I'm going to recommend a book before I make this quote. It's Jesse Livermore, World's Greatest Stock Trader by Richard Smithson. And Jesse Livermore, in this book, the author talks about how he used to say that the really big money, the big trade is, you have to be right and sit tight. And you can't be thrown off the bull. And I think personally that this is the trade that I've been on. And I don't trade gold. What I mean, this is the place I've been since 2002. And I think the break that we've had this year above 2,100 in gold confirms that I'm still right, and I'm going to sit tight. And compared this teacup of recent compared to the one from 96 to 2004-05, I think is a lot more powerful because it's actually at a top. The one back then was at a bottom. And the consolidation, as I said, took 3.5 years. So where will gold go and how long it will take? I don't know, but I think it will go a lot higher. And that's just reflecting the fundamentals for the fiat currencies. The debt now is multiple times higher than it was in 2004 or even 2008. The geopolitical situation, I don't have to tell you, is really bad. I can read you some headlines here. And unless you're living in a cave, you probably heard of all these things. Well, first one, it says UK probes potential failings at military contractor over suspected China hack. US revokes license for supply of chips to China's Huawei. And this is a video from the Duran, who are great at geopolitics on YouTube. They say Russia's final warning to Macron and Cameron, the British Foreign Secretary. FT reports Xi lashes out at NATO over 1999 Belgrade bombing ahead of Serbia visit. So he's not happy with the West. He doesn't forget. And then there's a tweet here about Ursula von der Leyen. She's threatening, the EU is threatening China as well with sanctions and tariffs because supposedly they're oversupplying Europe with cheap goods. But no, China's just competing better and selling better products. So, and I don't have to tell you what's happening vis-a-vis, the Middle East, Israel and Palestine. So, in times of war, and it really looks like the West wants to provoke Russia and China into a major conflagration. Hopefully, they won't really fall for the trap. That's my hope. But be as it may, the world's not unified like it was up until recently, where we're relatively peaceful and there was trade worldwide. The supply chains weren't disrupted. There weren't sanctions on countries like Russia. And I think China now sees the writing on the wall. So I'm going to show you now some of the headlines in the mainstream press, and it reminds me as well of the period around 2004 and 5, where the mainstream press was trying to say gold was going to go nowhere, right? And you probably know very well about this editorial that I've spoken a lot about. This was from April 2004, and gold was at $400, and the FT said that they said the pointlessness of holding bullion continues to sink in, going gold. So that's an example that you see from the mainstream press right around the time that you should actually be buying gold, not selling. So what am I seeing now? Well, the first one is from thisismoney.co.uk, and I think this is the money part of the Daily Mail. And the headline says, Britain's cash in on gold price boom by selling to the Royal Mint. And granted, they do say how to buy and sell bullion. But the way this article is set, it's like, oh, you should be selling your gold. And it says also that savvy Britons are cashing in on the boom in gold prices by selling the precious metals to the Royal Mint for a profit. Well, a profit in a failing currency, I would say. Yes, maybe if you're trading, you can sell it for a profit and, a few £1,000s or more and take a nice holiday. But to me, as I said, it's the big trade, and you got to be right and sit tight. Well, there's another one here, and I have to thank Greg Manarino. He covered this the other day, and I completely agree with him. This is from MarketWatch.com. I remember subscribing to this and being really This was a website I read every day in the late 90s before I woke up, right? MarketWatch.com. And there's a guy there called Mark Holbert, and he recently wrote, May 3rd, gold is overvalued now and won't help you beat inflation in coming years. New research sees gold lagging U.S. inflation by more than 7% a year over the next decade. I think he used some research from a guy called Claude Herb, a former commodity fund manager. I don't have the whole article because there's a paywall on Market Watch, and I'm definitely not going to subscribe to them. But suffice it to say, he's saying that gold is overvalued and won't beat inflation. But as you can see here from in Gold We Trust, gold has been averaging over 9% in US dollar terms per annum since the year 2000. Yes, it could change, but we all know how the debt situation, the deficit spending, wars, of course, that unfortunately we're going to continue to see are highly inflationary. And gold has been a good protection over the last 24 years versus inflation because it's performed at almost 10% a year. So that's the kind of thing you're going to see. The This Is Money article and the Market Watch article is going to put a lot of people off, people that don't really understand the fundamentals or even the technicals. So let's quickly go and look at the markets. And just to let you know, we're quite early today. It's 20 to 8 a.m. London time. We've got spot gold at 23.15. It's up just over $1. The low's been 07 and the high's been 23.21. Spot silver is at 27.30, up 7 cents. High's been 45 and the low 07. Dow futures up 15. The NASDAQ 100 futures up 9 points. S&P is up 2.8 points. The currencies, the pound is down about 0.2% at 124.90. Euro is unchanged. The dollars continue to pick up here against the yen. It's up 0.33%. It's back above 155. I think recently we got to 153. Commodities, WTI crude is down 2/3 at 77.70. Brent as well is down 2/3 at 82.50. High-grade copper is down over 1% at 4.55. I still think hard assets and commodities are the place to be. We're going to see, even if we see a small shift from the paper assets from tech into commodities, and it could be even bigger, it's going to make a huge difference. And they are, in my opinion, grossly undervalued, versus the real market. And again, with wars as well, everything gets disrupted in the world. Transporting commodities is going to be a lot harder, in my opinion. What about the bond market? Well, I've noticed, of course, that treasury yields have come off since the FOMC last week and the weak non-farm numbers. The 10-year yield right now is at 4.47. It's come off about 20 or 25 basis points since then. It's a fairly big move over a week, but it's not that big. I mean, back in 2020, we were seeing these kinds of move intraday. So what it says to me is that they're trying to keep the treasury market stable, and I've said it recently, they're trying to keep long-term yields down, and that's why Jay Powell decreased the amount of QT by $420 billion a year, which means he's going to be selling or letting a lot less long-term treasuries go off the balance sheet of the Fed, and that helps keep the market stable and well bid. So there you go. With that, I'm going to wish you all a very good day. Take care. Bye.